Inflation is down and Bank of Canada is smiling. And the headlines say, don't worry, it's under control. But is it? Because when your rent, food, and energy bills are still high, you know something doesn't feel right. Let's unpack Canada's latest CPI data, what it really means, what global markets are signaling, and why the next wave of inflation may already be loading in the background. Let's go. So Canada's CPI stayed flat at 1.7% in May. That's well below the 2% target. BNN Bloomberg attributes this to cooling rent hikes, lower gasoline prices, and a softer energy market overall. It's the lowest rate we have seen in a while. And yes, that's a good signal on paper. But CPI doesn't tell the full story. Here is the trick with CPI. It doesn't measure the actual price levels, only how fast they are changing. So if groceries went up 15% last year and only 1.7% this year, that is still 16.7% higher than 2 years ago. Your wages didn't go up that much. Your cash hasn't stretched further. You just learned to live with more expensive everything. What helped this soft landing? Rent hikes have cooled but not reversed. Oil has come down, lowering fuel costs. Now, this is comparing May data, right? The oil prices have gone up recently because of the Middle East conflict. And there is a massive pressure on BOC to start cutting rates. But if they cut too soon, before the inflation beast is fully dead, we are risking reigniting it. This is the tightrope walk. Globally, markets are moving fast. The US dollar is sliding. Oil prices are dumping. Stocks are rallying, even with ceasefire violations still unresolved. It looks like the market is betting on lower inflation, lower rates, and higher risk appetite. But here is the danger. What happens if the US dollar keeps falling? Let me explain why that could backfire right here in Canada. On the surface, a falling US dollar sounds like a good news for Canada. It makes imported goods cheaper if the loonie rises. It boosts our global purchasing power. But here is the nuance. If the US dollar weakens because of Fed rate cuts or money printing, global commodities like oil, wheat, copper start to rise in USD terms. And since we buy most goods on global market, even a small depreciation of loonie can mean more expensive imports. Think groceries, fuel, construction materials all going up. Also, Canada isn't guaranteed to get stronger when the USD weakens. If our economy slows, if unemployment rises, if the BOC cuts rates too, our dollar may fall right alongside the US dollar, meaning we import inflation all over again. Now let's zoom back in on the Canadian economy. GDP per capita still flatlining. Unemployment rate has jumped to a 9-year high outside the pandemic. Household debt is still among the highest in the G7. So even if CPI says inflation is under control, most Canadians are still stretched thin. We are in what I call the silent squeeze, where nothing crashes, but everything hurts. Here is what I would tell my friends. Don't trust the CPI blindly. Watch money supply, currency strength, and global trends. Start thinking in real terms, not just dollars, but what those dollars can still buy. Own assets that beat inflation over time. Real estate selectively, productive equities, gold, and Bitcoin. Learn macro, because once you do, none of this feels random anymore. If this is the kind of clarity you are looking for, check out my macro fundamental course. It's built to help you think like a global investor, even if you have never studied economics. Link in the description below. And if you want real-time insights and smart people to chat with, join my WhatsApp community. We're building wealth by understanding reality, not headlines. On that note, hit the like button and subscribe to the channel and send this to someone who thinks inflation is done because the government said so. See you in the next one. I just wanted to let you know that I also offer one-on-one consulting calls to the individuals who are looking to discuss their financial planning, their investment strategies, their kids' education planning, their immigration moves, as well as the young professionals, because I have been in the tech industry for almost 20 years. So I also offer one-on-one consulting calls to the young professionals who are looking to have their career development discussion with me, and also personal branding as well. So if you are looking to have some sort of an expert opinion, there is a calendar link in the description below. Book a 30 minutes call with me and I will be more than happy to help you out.